please listen to this video very carefully, and I will ask you a question towards the end. Whoever answers that question well will get one of my favorite books delivered to your doorstep. Hi everyone, welcome to today's video. So my mother-in-law yesterday asked me a very interesting question. She asked me that, Akshat, I have this lump sum amount lying with me. Tell me how I can invest it to make regular income through this money. So my obvious answer was that go and invest in a fixed deposit. Now problem with fixed deposit is that returns are very low. You will get paid 6.5%. After tax it comes out to be 4.5%. Second option is that, okay, go buy a house, right? And you can rent it out. You will get regular monthly income from it. Again, the historic return from the real estate sector, especially in the last decade, it has been very low again. Third option is a more risky option, that go and invest in a stock market. Problem with stock market is that there is no concept of making regular income, because sometimes the stock markets can go really up. Some days it will go really down. There is a lot of volatility. You can't do a systematic withdrawal plan and execute it really well. So it becomes difficult to make money in a regular fashion. So on this video, I'm going to help you understand one key option as to how retail investors can invest their money to make regular incomes. I'm also going to discuss the platform through which you can invest to make this regular income happen for you. So let me first and foremost help you understand all the options that you have to make regular income, and let me plot that on a graph so that you understand the concept thoroughly. So I will just repeat these very quick important points because this is very important. So the first option that you have is fixed deposit. Now here the issue is that the risk is very low, but returns are also very low. Now the second option that you have is that you can go and do things on rent. You can go buy a property in an outright manner, but again here the risk is high, right? Risk is high and the returns are not that high, right? So this is problematic, especially given the scenario how real estate has performed in the last decade. Your third and the most popular option is that you go and buy stocks, or you go and invest in mutual fund, especially debt mutual funds, and you try to make regular income out of it. Now this option is not bad, but there are a lot of problems associated with it. First and foremost, mutual funds charge you a lot of commission, especially debt mutual funds. So please be very careful and cognizant of the fact how much expense ratio or commissions you are paying to a debt mutual fund. Be very careful about that, otherwise you will lose a lot of money just in commission. Now associated problem is with the stock market. Here the risk is also high, the returns are also high, but problem is that doing the systematic withdrawal from the stock market on a monthly basis, what to sell, what not to sell, that becomes like a major headache, right? So doing it consistently month after month, it is a big problem, and it is not a very reliable way of making regular income. So this gets us to the fourth option, where you go and invest in the bond market. Now please don't drop off, because I'm going to speak about the bond market. There is a prize for you. If you write the answer really well in the comment section, you will get a book from my side for free. One of my favorite books. I will send it to you for free. So please listen to this video very carefully, and I will ask you a question towards the end. Whoever answers that question well will get one of my favorite books delivered to your doorstep. Now before I talk about how retail investors like you and me can go and invest our money in a bond and how much return are we going to make, what is the risk profile like, let me very briefly explain what bonds exactly are. So bonds are primarily of two types. One is a government bond and second are corporate bonds, right? Now the function of both is very similar. So let us understand this through an example, that Kerala government comes out with an infra bond, right? So infra bond. So whatever money they raise by selling this piece of paper, which is called as bond, so they will go out in the market, they will publish in the newspaper that, hey, we want money because we are undertaking these bunch of different infrastructure development projects. We would like money for it. This piece of paper, you can go and pay us this money on this particular account, and this is the mechanism. And this bond will have a maturity of 5 years, and we will pay a rate of interest of 8%, hypothetically speaking. So essentially the government is selling you this piece of paper. You as an investor will pay the government certain bit of money. You will keep that piece of paper with you for a period of 5 years. Why? Because this is the maturity period of this bond, and you will get 8% as the interest or yield, right? There is a slight difference, but for our understanding, let's assume that 8% is the interest that you will get on this piece of paper. Now other factors will also be outlined. For example, will this payment of 8%, will it happen on yearly basis, monthly basis, quarterly basis, half yearly basis. All those specifications and modalities are written. But for the point of understanding, what you need to understand is that governments, private organizations can come out with their own set of bonds. For example, Kerala government can come out with it. Similarly, JP Morgan can come out with its own bond. Bond is essentially a piece of paper that you get. When they sell you this piece of paper, you give them money. Why do you give them money? Because they give you a certain rate of return on that piece of paper. So that is what bond is. And each of these bonds are given a certain credit ratings. You will understand more about the ratings when I show you the platform. But these bonds are given certain credit ratings by organizations like CRISIL, which are credit rating agencies. They will rate these bonds as AA, A, AAA bonds, which literally depicts that how safe is it to invest in these type of bonds. That is the mechanics of a bond. Now let me move to the interesting part. So I will pick the best answer from the comment, and the question is that please explain the utility of masala bonds. So you need to read up what masala bonds are, and you need to explain in the comment box what is the utility of masala bonds. I will pick 3 winners who are answering this question really well, and I will send them my favorite book. Please keep an eye out of the community post as well. I'll make a community post announcing the winner sometime tomorrow. So please keep an eye out for that. Now, before I show you how to actually go and invest your money in a bond and whether or not you should be investing your money, let me very briefly touch upon the fact about the size of the bond market in India versus the developed countries. Now, if you take a look at the European markets or the US markets, the size of bond market is much bigger compared to the stock market size. In India, the bond market is under-penetrated and it is still developing. So this means that bond will become a more viable investment instrument as people age, and there are different types of investors who will come into the market. So right now in India, if you want to invest in bonds, there are 2 mechanisms of purchasing bonds. One is through primary market. So primary market means that, for example, the Kerala government comes out with the announcement that, hey, we are launching our infrastructure bond. Do you want to invest it? Then entire listing of that bonds happen and you can go and purchase that bond. That is called as primary operation, because you are directly purchasing that bond from the Kerala government and you are going to hold it till maturity, 5-year period or 10-year period that has been specified on the bond. So that is primary. Now let's say that you don't want to hold this bond for 5 years or 10 years that has been stipulated on the bond. Then what do? You have to pick up that bond after 2.5 years whenever you want to sell it, and you have to go to a secondary market. So secondary market is more like stock trading. So you go and try to sell that bond. Now who does the selling? It's not you and me. That who does the bond selling on the secondary market? These could be big mutual fund houses and bunch of other large investors. We don't need to worry about it. But the point is, when you are buying bonds in a stock format, the liquidity is very low because people in India do not actively trade in bonds. So therefore, there's an over-the-counter option where you can go and purchase these bonds, where a lot of secondary listing also happens and it gives you a lot of options in terms of bond buying. All this theory you don't necessarily need to understand. You simply need to understand the point that, hey, if you are a retail investor, how you can go and get access to more bonds? Use the platform called as Golden Pie. It is India's foremost marketplace for bonds, and you will get a lot more options in terms of purchasing bonds. So let me help you understand more about bonds by taking you through the platform so that it helps you understand more about the options in terms of buying. So for example, let's say that you want to invest 2 lakh rupees in a bond. So what you need to do is that you need to go on this Discover Bonds tab and you need to understand your investment purpose. Why is it that you are trying to invest in these bonds? Do you want to make tax-free returns? Do you want to invest for the short term? Do you want to earn higher fixed deposits? Do you want to earn higher fixed income than FDs? So I will click on this. So let's say that I go with this option, and these are all the options that I will have. So I can go and study these bonds further. Now you see all this stuff, right? A- rating is there. You have India Bulls, which is AA rating. Then you have India Bulls again AA. Muthoot FinCorp has A- rating. Now, the stronger the rating, AAA would be the best bonds out there in terms of safety. The stronger the rating, the safer it is, and accordingly, because you are taking less risk, the returns will be lower. So for example, let's look at South Indian Bank Limited. Yield means the interest rate that you will be getting. So you'll be getting an interest rate of 13.7%. So call date is when the bond gets matured, and here the payments will happen on yearly basis. It's not as if that you will make monthly regular income. Here you will make yearly regular income. Okay, so let us understand the semantics of South Indian Bank Limited bond that I was highlighting. So here you can see that this is the minimum investment amount that you need to put, and this is the yield or the interest rate that will be paid to you on annual basis. So every year you will be making approximately 13.6% returns on this. Payment terms are yearly. Now, this is very important for you to understand about the credit ratings. Now, usually I would recommend that if you're a new investor in the bond market, you should not invest in bonds that has a less than A minus rating, right? So this meets the borderline from that perspective. This is A minus. Bonds are relatively safe. It's not as risky as stock market, but that does not mean that bonds do not have risk. They have risk. They are more risky than fixed deposits. Therefore, the returns that you are making is also higher. But having said this, generally speaking, bonds are considered to be safe, at least the ones that have good ratings. Good ratings would be A minus, A, AA, AAA, these type of bonds. Now you also need to understand a little bit about debt quality. Now here you will see seniority. So it simply means, for example, let's consider that JP Morgan issues a bond and JP Morgan goes bankrupt for some reason. Then what happens? Bondholders get the first dibs on whatever assets that are being liquidated. For example, JP Morgan will have buildings, it will have cars, whatnot, right? So all that will be sold by regulators. Whatever money is coming in, that will be distributed in order of seniority. So the first dibs or the first people who get repaid from this liquidation exercise are the bondholders. Even in that bond, there are different tiers. So you will see seniority. In case of default, the bondholders will be considered subordinate for payments. Subordinate compared to other bonds, right? Not subordinate compared to stocks. For example, senior debt might be paid first, then this particular bond will get paid first, then stockholders will get. So this is the liquidation exercise. I'm explaining it to you in super simple terms. So don't get scared by this entire dynamics that, hey, what if default happens? Defaults can happen because it is an investment instrument. But having said this, bonds are considered to be generally safer, especially if you are invested in a good rated bond. Now, another way of understanding which bond you should specifically pick, you need to understand who the issuer of the bond is. For example, here the issuer of the bond is South Indian Bank, and you can read about the history of South Indian Bank. Now, unless something really bad happens with South Indian Bank, this bond will mature and you will get paid stipulated amount. So you need to understand that banks generally do not go under that easily. That's one. And second, you can compare this to other banks, right? So here there is a good feature. For example, you can compare the South Indian Bank's bond that we are talking about with IDBI and bunch of other banks, right? You can take a look at the entire investment amount needed, what is the yield, what is the duration, what the repayment options would be like. So you can do that analysis and pick an instrument that makes the most sense to you. So as a retail investor, you can use the Golden Pie platform to participate in this bond. It's super easy, super intuitive to use. I will not go into the details of how exactly to use it. If you use the platform, you will understand it. Now, as the final section of this video, let me help you understand some of the key points associated with bond investing and who the investors should be in the bond market. First and foremost, bond investing is for people who are looking to make safer investments. For example, in my case also, I am 95% growth investor, 5% safer investor. So most of my money is into growth. For my mother-in-law, with whose example I started, she wants to keep most of her money safe. So in her case, she needs to invest almost 70% in defense and 30% for growth. So in her case, it makes a lot of sense to do bond investing. That's one. Second, even if you're a moderate risk investor, I'm a growth investor, I'm a super aggressive investor, my mother-in-law is a defensive investor. Similarly, if you're a moderate investor, then again, bond investing can be a great instrument for you. Rather than putting your money in a fixed deposit, you could consider putting your money in a bond instrument because it allows you to generate more risk-adjusted returns. Now, final point. A lot of you might say, Akshat, is bond safe? Again, I will stress on the point that bond is not a risk-free instrument. Please don't assume that bond is a risk-free instrument. But compared to stock markets, compared to crypto markets, compared to large cap stocks also, bonds are safer. So I hope you enjoyed the video. Do give the answer to the utility of masala bonds. I will pick 3 winners and I will announce the results tomorrow through a community YouTube post. I hope you enjoyed the video. Please press the like button and I will see you the next time.